Hello, everyone, and I am the coach, Kemp Boyd, Executive Director of Love Akron, and we are so privileged and honored to be partnering today with FSP, the Cleveland-Akron chapter, to really bring about a sense of wholeness, if you will, to the entire person. We talk a lot about physical health. We talk now in this season of COVID, we're talking a lot about mental health, as well as we want to talk about financial health and what does being financially well, what does that look like? And how can we help to achieve that? And so I know, me being a coach, I need coaching, not just in some aspects of my life, but in many different aspects of my life. And so we want to help people achieve financial security today, or at least begin the process of what that could look like for you individually. So I'm not by myself, because this is not my expertise, right? I'm a coach, but I'm a coach in different things. And so I want to bring about and introduce you to someone that has become a friend to me. I would even say that she's a sister. Brandy, I met Brandy about a year ago now, that we was just talking about, and man, we have been plugging away at really how can we bring this sense of financial wellness here in the Summit County to help to be a blessing to our community. And really, I've been riding on Brandy's coattails because she's been educating me and leading me through this process as well. Brandy, thank you so much for your diligence, that, man, we can really bring a sense of help and healing into our community as we talk about achieving financial security. How you doing today?
I'm good. Thank you so much for having us today.
No problem at all. And it's funny because we were talking about yesterday, we were talking about our grief recovery method that we're doing. And they said grief is also the result of, the result of not just of a loved one, right? But it's the result of a loss of dreams, goals, or expectations. right? And we talked about in this season of COVID, how many people last year, January 2020, were like, man, I'm getting out of debt this year. I'm going to buy a house this year or whatever. And then COVID happened and all that comes to a stop. And it's like people had to go through the process of grieving the loss of that expectation, right? Or that dream that they had. But man, that doesn't mean that the dream is over, Brandy. Like there's an opportunity to kind of wipe the dust off of that dream, if you will, and say, hey, man, let's get back on this. And so today you brought a team of people with you that, man, know a lot more than I know. So I'm going to back away. I'm going to stop talking because I can kind of get going down the line. And Brandon, I'm going to turn this over to you and to your team. Thank you so much again for being with us and leading us to achieving financial security.
Sure. Thank you so much again for the opportunity to speak with you all today. Before we even get into the presentation, Kemp brought up the word FSP, and so some of you may not be familiar with who FSP is or what we do. FSP stands for the Society of Financial Service Professionals, and we are a multidisciplinary community, and we're very accomplished professionals, and our primary purpose is to deliver the highest level of ethical service to our clients. So that may mean, it might be investment advisors, it might be CPAs, it might be insurance professionals, it may be attorneys, it may be certified financial professionals, but all of us gather together. We share education and in hopes that it'll help to advance our clients' goals and aspirations, as well as to protect their financial future. So that's a little bit about who we are. I am going to share my screen so we can get started. Hold on 1 second. Okay. Can you guys see my screen okay? Okay, great. All right, so as financial professionals, we really do have the honor and the privilege of helping you plan for some of the most memorable moments and seasons in your life. Buying your first home, weddings, vacations, retirement, and more. We're also kind of like life coaches. We come alongside you to provide comfort and peace of mind in some of the most challenging and vulnerable moments that you may have in your life, such as divorces, job loss, a death in the family, or illnesses or injuries. So our overall goal is to provide you with hope and financial confidence about your future. And we do this by providing the financial literacy needed to help you plan for the planned and unplanned circumstances in your life. And so that's our overall goal for today. Again, thank you to Coach Kemp and Lori Porter for partnering with us in this journey, and again, just arising as a leader and addressing this need within our local communities. So before I begin, I want to introduce you guys to who our moderator is going to be, which is Alvin Turner. He is the president of a nonprofit organization called Take Charge of Total Wellness Foundation. He's also a past national president of FSP. He's an author, a speaker, an industry analyst, and he's a student of people. So he's got a wealth of experience and knowledge that he'll also be able to speak to today. These are our panelists. I'm going to start with Rob Johnson. So he is a financial service professional with New York Life. He's going to be speaking to us today about investment planning. We also have Joe Fragapane. He's a senior VP private banker. He brings over 36 years of experience in helping with consumer banking and commercial private banking, as well as a great sense of humor that I'm sure he will be showcasing today. Sarah Gaines is our certified financial planner. She's with Sequoia Financial, and she brings about 8 years of experience. And then last but not least, Kurt Thomas is going to be speaking to us about insurance protection. He's with JL Thomas and Company, and he is bringing about 10 years of experience to the table today. So after giving a brief overview of a case study that we're going to get ready to share with you briefly, each of our panelists are going to be sharing their experiences and giving tips that have helped others create financial balance and confidence. And then there will be a live Q&A, and we definitely want to encourage our audience to participate in. Bring your questions, your concerns, whatever that may be. Our little disclaimer. Before we get started in the presentation itself, there's one thing that we want all of you to kind of keep in mind. As you're working towards any financial goal, you want to have a basic understanding of your financial picture, whatever that may be. So, begin by asking yourself, or maybe even just writing down, what are your financial assets and liabilities? And these are just examples here on the screen. Your assets, maybe you're checking your savings, maybe your 401k. Liabilities, maybe your rent, your mortgage, credit cards, things of that nature. So if you subtract your financial assets from your liabilities, it actually equals what's called your net worth. So an example of your net worth might be the equity in your home. So we just want you to kind of keep this image in mind as we continue to talk through the case study. Once you know where you stand working with a financial professional, you can discover what is needed to help you achieve your goal or goals, and what insurance protection you may need to ensure that you can actually achieve those goals. So now I am going to hand it over to Alvin, and he can start hearing from our panelists. Alvin?
All righty. So thank you, Brandy. So let's start with a case study. And we're talking about Bobby. Bobby, age 22, and presents some serious issues for our panelists. So Bobby just graduated from Ohio State. Oh, I'm told the actual name is the Ohio State University. Just graduated from there. So let's review the schools he looked at before he decided on Ohio State and the cost of those schools. So the schools are as follows. In this chart, you see the school on the left and what it costs over 4 years in the middle column, and then why he liked the school on the right. So the first school is New York University. It's $308,000, which is $77,000 a year over 4 years for tuition, room, and board at New York University. And the reason he liked it is because he likes New York City. Notre Dame, you see the $296,000 over 4 years. That's actually $74,000 a year for the 4 years. And he likes Notre Dame because it has great sports teams. The Ohio State University, which is where he went, $100,000 a year. Let's assume he's in-state. So that's in-state tuition at Ohio State. And he likes it because it has an incredible football team, I'm told. I'm in Connecticut, so I'll just kind of take your word for it. He got scholarships, but he still accumulated. Next slide, please. He got scholarships, but he still accumulated $30,000 in debt as he went for that 4 years, and he has no clue how he accumulated that loan balance. So he's got a job now, making $35,000 a year. His budget is tight, and he cannot make his loan payments, the student loan payments every month. He doesn't have enough money to make those student loan payments. Panelists, can we help Bobby? So, Brandon, can you start us off talking to Bobby about thinking strategically about his financial situation?
Sure. So for many of us, when we go to college, I know personally when I did, the biggest focus was graduating and get a job ASAP. That's all we really cared about. But the story doesn't end there. And Bobby is faced with some tough questions to answer of how to balance addressing his financial obligations, but also, he still wants to achieve his financial goals. He wants to establish a career. He wants money to be able to buy a home and take vacations and, all the various different things that go through your mind when you're graduating from college. For some of us, it's overwhelming to think about where to even get started, especially if the conversation or examples have never been displayed at home with family or with friends. So our panelists are going to talk us through how to be intentional and strategic, and how Bobby can repay his loans, save some cash, have some liquid cash on hands, build investments, and protect his financial assets as he builds personal wealth and stability.
All right. So let's talk about, so thank you, Brandy. So let's start this discussion with this whole process of thinking strategically about paying loans, savings, and investments. And let's start with loan management and credit scores. So Joe, let's go to you. In general, what things should a person consider when they're planning to sign up for a loan?
Thank you, Alvin. Good afternoon, everyone. It's a pleasure to be with you all this afternoon. You know, the audience, I would imagine, is pretty diverse, but from an age standpoint, I'm going to assume that we have some students and young professionals who have just graduated college or are just getting into college. So, you know, as you're looking at the options available to you or being offered to you, whether they're available or not, you need to really be conscious and very specific to what you're looking at. I will lead this with a live example. I'm the father of two, and my youngest is graduating from high school at the end of this month. He's going to be studying aerospace engineering at Purdue University, or in Indiana, they would refer to it as the Purdue University. And already at home, he is receiving credit card offers from national credit card providers on all the benefits of having access to credit and what you can use your credit cards for on campus, and to buy books and to to use for personal reasons, and all of these wonderful things. But these are marketing brochures where you, as the potential borrower, you really need to be aware of what's in front of you. You have to be responsible, and don't do it alone. Have a parent or guardian with you, or a family member, to go through what is being presented. These were credit cards that come to the student who, by the way, my son has no income as a high school student, but is being offered credit. Those have to be paid back. And the interest rates on both of these wonderful offers were 24%. Those are egregious, but they are real. So when you are looking at a loan, let's just call it a student loan in college, be aware of what is being asked of you. Are you the only borrower on the loan? Are there going to be parents or guardians that will support the request for the loan? Realize none of this is free, and eventually you'll have to pay those loans back. And with student loans, there are subsidized and unsubsidized loans that are provided by the federal government. And so pay attention to whether these are student plus loans or the subsidized loans. And a very big distinction between the two is a subsidized loan provides, let's say, up to $5,250 a year of financing your tuition costs. The interest that is being generated is actually subsidized by the federal government. So you're not making those loan payments until 6 months after you graduate from college. Then they become they go into the repayment stream. So you want to be aware up front what that means when you graduate from school, so that you are being responsible each year as you're accumulating potentially more debt, to recognize what the obligations are going to be and what those payments are going to look like when you graduate from college. The other loans are loans that parents and guardians can take out on your behalf while you're in college, and they're making those payments now. Interest rates are relatively pretty low, but the obligations begin, right away. So things to be familiar with is really on the onset, what are you getting yourselves into? And please look at those in a responsible way, because there will be a day where you're paying those back. So if Brandy, you can go to the next slide. If there's anything that you take away with you today, I would really hope that you understand the whole topic of a credit score, the power of credit, what it means. you will know, it doesn't matter how old you are, your credit score will come and follow you throughout your life. And this is something that you need to protect. It is one of your most trusted financial categories that will determine your cost of borrowing. Not only now, but when you're out of college, you have a full-time job, and let's say, you've been in your career for 20 years. The cost of borrowing credit is all based on credit scores. You can't move away from it. So credit scores will follow you on not only your borrowing rates on a mortgage or a car loan, or actually the lease of an apartment that you may rent. It also affects your insurance premiums. And things that really in all financial sectors. So you need to protect your credit score. And what is it? It is a way for the lending institutions in the financial service industry to determine your ability and your willingness to repay. And many of us would feel that the credit scores are over-influenced in today's society, but it is a reality. And so you need to protect it. You need to be aware of it. And I'm just going to give you some bullet points of what you need to kind of recognize on how credit scores are determined, right? So,
Hey,
there's
Joe, so question for you, just a reality check. I heard some employers also are looking at credit scores, and some people who are renting apartments are looking at credit scores.
Yes, Alvin, excellent comment, and very, very true. The credit score is a gateway, if you will, to the perception of your financial responsibility. Are you a responsible person? And financing is one way of showing that. So employers want to know, are their employees responsible in their own personal finances, which can lead to how responsible they are in their job. So yes, and it does affect, again, the ability to get not only an apartment rent, but what that rent payment could be. So yes, the most important part of the credit score, and please do not underestimate the value of what I'm going to tell you right here, is your willingness and ability to repay your monthly obligations on time, every time. Every time. Can't take a couple months off because you've done a good job. Unfortunately, it is the biggest component to a low credit score are people who are making their payments late. And late is determined after a 30-day window. So if you have a credit card payment that's due July 1st, and on August 2nd, you make the minimum payment, you're 30 days late, and it's going to have a negative impact on your credit score. So please recognize that the timeliness of your payments are critical. It represents 35% of your total score. So it's more than a third of the component. The other components that will affect your credit score involve outstanding balances. So if you have a number of credit cards, having availability within those credit cards shows not only financial responsibility, but also that you're within your capacity, that you're not using all and leveraging all of your credit availability, because it could tumble into a problem. So the balances that you have under your lines commitment affect 30% of that. Credit history for young people like who I believe are in the audience this afternoon, that is an issue of age, right? So how long have you been able to have credit, and to what levels of credit lines are out there? So do you look at opportunities with a family member or guardian or parent who may be able to get a credit facility with you on it? That's one way of establishing credit. Taking opportunities that the universities may provide with the banks or credit card companies who recognize that college graduates have a much higher credit score than those who may not go to college. Take advantage of maybe those pre-approvals but be responsible and manage them accordingly. That helps build your credit history, and that gives you a strong credit score. The type of credit is also important. It represents 10%, but it's still a component. So if in your credit report, all you have are charge cards and you don't have installment loans, well, what's an installment loan? A car lease, a student loan. Those are loans that require the repayment of principal, the original loan amount, back over a period of time. Having a balance between those scores, between those type of products, determines your credit score, because it shows what looks to be a consistent pattern of reducing and clearing your debt. And then finally, inquiries on your credit bureau. If you're applying for credit and the provider, the creditor, recognizes that there are 4 or 5 other inquiries that have been made within the last 30 to 60 days, that is a concern to the lender, to the provider, because is that individual, is that applicant out there trying to get as much credit as they can? That's a concern, because it can tumble in a way that maybe that individual won't have the capacity to repay those back. So these are the components that that really affect your credit score. It is an ongoing number that changes each month. And I would again say that the repayment history is the most important factor that has the biggest impact on that number. Brandy, if you can go to the next slide. This is the last slide I'll mention. So what is a credit score? And what do the numbers mean? So from a lending perspective, these are the categories of what is consistent across the country with different credit providers. If you have a credit score of 740 or higher, and depending on the repository, credit scores can go up to 850. Those are your top credit scores. Those are the individuals that are borrowing at the lowest rates. They have the most favorable terms, and they've earned it. They've shown a history of repayment on time, every time, and they've shown the balance of responsible financial management of their credit needs. So 740 is where you want to get to. If you're starting out, it'll be difficult, but you can get there quickly by paying your bills on time every time. And then from there, depending on the type of credit you're looking for, if you're looking for a mortgage and you want to buy a house, that 740 number is important, because if it's less than that, you may pay a little more for your loan rate. But if you're applying for a car loan, a smaller type loan that's only going to be out there 5 years or 6 years, then a 700 credit score gives you the best rates in the market. As you start to fall into the high 6s, you start to see that maybe it starts to become a little more expensive or a challenge. But I promise you this, if the credit score is below 650, you're going to be paying higher costs for your insurance, your rent, your car payment, your mortgage. And if it's below that, you're going to find it difficult to even establish credit. So again, the takeaway this afternoon, and again, thank you for allowing me to be part of this, is recognize that credit score is part of your name. It follows you wherever you go, and you have to treat it and respect it as you respect yourself, and recognize the opportunities that afford you in the future. So good luck to all of you.
Joe, this has been fantastic. Brandy, how are we doing on time? I have a couple of questions, but if we need to move, we can ask those during the Q&A.
We have about 20 minutes left, so we'll need to
move along.
Yep.
Okay, let's move along. Sarah.
That's me.
Let's talk about let's talk about Bobby, and use this case study to illustrate how he should manage on a tight budget. His goals are to pay loans, save, and invest.
Absolutely. Those are great questions. And thanks, Alvin. And it's nice to see all of you. So today, as Alvin mentioned, I want to be talking a bit about budgeting, prioritization of your expenses, and then dig into Bobby's financial situation as well. So feel free to ask any questions that you might have in the chat, or afterwards, we can certainly address them as well. So first, we wanted to talk about creating a budget. And I know that this can be a little bit tricky at times, but the key is to truly know your numbers and know what's coming in and what's going out. And really budgeting is more of a mindset. A lot of times people think budgeting is limiting what you can spend, but if you can change your mindset to knowing what you can spend your money on, budgeting is really a powerful tool moving forward to provide some peace of mind. And it's really a way to know your cash flow and then also be updating your balance sheet that Brandy had talked about earlier. So knowing what your assets are, knowing what your debts are, and then watching your net worth grow over time because you have control over your financial situation. There are so many free resources that you can use that help you build a budget. I know personally I use mint.com. That you can go in, plug all of your assets into, and then it manages what you're spending your money on, and you can really go in and build a budget from there. And then also, as to what Joe was talking about, it also helps to monitor your credit rating. So it can help you see how you're progressing over time. A large part of budgeting is prioritizing your expenses and your goals. And having those loans, those student loans, are a huge part of the prioritization because that can really impact your credit over time. So really knowing what the priorities are of what your expenses are, and then going in to make sure you can achieve those over time. Once you have a budget, we can then start to talk about discretionary income. And what discretionary income is, so you know what your income is, you know what your expenses are, and then over time, we want to make sure that your income is more than your expenses. So if you have a surplus on hand, then we can determine what to do with that moving forward. A lot of times it starts with establishing an emergency reserve, which would be about 6 months of your expenses. So that would be more of a rainy day fund if your car were to break down or if there was a health bill that had to come up. So there's a lot of different things that would make sense to have a rainy day fund there. In addition to that, if there's more than that 6 months on hand, then we can talk about investing for the future with what your goals are. So it seems like a long time away, but there will be a day where you'll want to retire and you'll need a nest egg of money to do that. And the earlier that you start, the better off that you'll be. And really knowing what those numbers are will help you to accomplish your goals much faster. So now we can get into Bobby's scenario. So if you could go to the next slide, Brandy. So when we look at Bobby's scenario that Alvin had talked about earlier, he has a gross salary of $35,000. He has benefits. So those benefits would be state, local, federal taxes, medical insurance premiums, and then his 401k. And that totals about $12,000 over time. He does have his student loans. So that's about $3,400 every year that he needs to be putting towards those loans, in addition to his living expenses, which right now are about $25,000. So it gets pretty hefty over time and things start to add up. So after everything going on, once you take his income and subtract his expenses, you're left at a deficit of about $5,000 a year, which equates to about $425 a month. So we'd want to take a look at his overall picture and say, where can we cut? Look at his entire budget to say, this is what we're spending money on. This is where we think that we could save a little bit. And some things don't necessarily change the way that you're living your life. It's just thinking a little bit smarter about how you spend your money. So if you'd like to go into the next slide, Brandy, that would be great. So when we look at Bobby's overall budget, right now he has about $6,000 of credit card debt that he's paying 20% on. And as Joe mentioned, that's a bear. That is a lot of interest to be paying on a monthly basis, and it just compounds on top of each other and continues to grow. And there's a lot of different offers that you can shop around to potentially try to consolidate those loans and refinance those loans. So there's different opportunities. So if Bobby could find a credit card that could potentially refinance to a 13% rate, or another type of loan where he could get 13%, that could save $420 a year right off the top. Bobby's also spending about $2,000 a year on vacations. And this is where the priorities come in. So It stinks to have to cut a little bit of that vacation bill, but knowing that you're setting yourself up for success in the future with your financials is incredibly important. So cutting that in half to $1,000 per year and saving $1,000. Right now, Bobby's spending $1,500 a year on his cell phone plan. And when you look at different plans, that seems to be a bit heavy. There's different plans where you could get that are $50 a month in exchange, which would be, $600 a year. So he would be able to spend save about $1,000 there as well. And then his car loan is also at 9%, which with interest rates right now, interest rates are relatively low. So being able to refinance that car at a lower rate could save about $400 a month. So overall, he would be able to not make drastic changes to his daily living and cut $2,100 off the top. There's also different situations that you can have to shop around for different car insurance, or potentially look for other ways to get some supplemental income as well, as Bobby works in his full-time job. Can you go to that next slide, Brandy? Sounds good. So then here is Bobby's situation after. So we've been able to reduce his living expenses to about $22,000 per year, which creates a surplus before student loans, but still has that deficit of $2,000 before, which is then when we can look into those other situations of where else can we cut, what the priorities are, and making sure that we can get those student loans paid. So that way you can have good credit scores for the future, which sets you up for financial success. Back to you, Alvin.
Super. So thank you so much. Boy, this is a rich discussion. I want to get to Rob and Kurt, and then let's come back to the questions. So we've talked about loans. We've talked about starting this whole budget process. So let's talk about thinking strategically about protecting assets while building wealth. And so we'll start with investment planning. And Rob, if you can take us there, and then right after you, don't wait for me. Right after you, Kurt, please come in and talk about protecting the wealth that you're building. So Rob, please take us forward.
Okay, fantastic. I appreciate everybody being here in that point there. I'm actually in the process of switching room. Both my neighbors decided to cut the grass at the same time, so I have to apologize on that one there. But Joe and Sarah touched on a lot of these things, which is very important already. Naturally creating a budget for yourself, knowing exactly where your money's going. That's very important, that point there. Paying your bills on time. Joe talked about that point. It's very important. And also setting aside money as far as a budget. Now, when we talk about that, that could be your discretionary money, meaning the money you spend on entertaining and shopping. Sarah touched on that a little bit on that point there. I'm going to talk a little bit about the 401k plan in the next slide, though. But I think one of the most important things that we need to talk about here all right, as we go into the investment plan, that point there, now we've established a budget. We understand where our discretionary money's coming from. Oh, you went back on me. That's all right then. Okay, then we'll go with the flow. We'll go with the flow. So we talked about basically establishing a budget, understanding where your discretionary money comes from and what bills you have to pay. Now we're going to talk about what to do with those funds in that point there. The first thing we talk about is, well, what is your plan as far as growing your money? What do you see yourself 10 years from now? Where do you see yourself 20 years from now? Write those goals down. Those goals are very important. And they say out of sight, out of mind, you don't have it. But if you write it down and keep those goals, you can achieve those goals. How much money will you need at retirement? What do you plan on doing at retirement? What's important for you at retirement and everything else there? Now, when we talk about diversifying portfolios, we talk about diversified portfolios. The main thing is not putting all your eggs in one basket. Now, there's three parts to that, and we're going to talk about a little bit more in detail. The first part, which is not on here, is what you call your cash part. Now, your cash part is actually funds that you can liquidate all at once, okay? Meaning you can have easy access to those funds. At the same time, there's very low interest earned on them, okay? Now, the advantage on that is both of those two folds, but also there's a disadvantage on that side there. Well, the disadvantage is they pay low interest rates. Low interest rates does not keep up with the rate of inflation. The rate of inflation is basically how much a loaf of bread is going to cost you 10 years from now. So if you have your eggs in that one basket, which is the cash basket, if it's growing at 1% and the rate of inflation is going at 3%, you're actually losing 1%, 2% on your growth of your funds every single year. But it's very important still to have your funds in that cash point because you need to have funds that you can access right away. The second part of your portfolio, let's say we put our eggs in bonds. Now, when you're bonds is basically saying that basically you are lending your money out to a person that they're going to borrow it. And that borrower at a period of time will pay you back the principal on that money and the interest earned. That's the maturity date, okay? With bonds, now you got a better advantage of growing your money past the rate of inflation. At the same time with bonds, there's a disadvantage with bonds, meaning that the loaner or the person that's you borrowed the money from can default on the loan, meaning that they won't be able to pay that bonds back to you in that point there. So that's very important to know in that point there. Now, the biggest part of anybody's portfolio, let's say you try to put your eggs all in one nexus, was what we call the stock portfolio. The stock portfolio is what we call security, equity ownership. It's a fraction of a corporation, which is based on shares. So basically, the shares that you buy, hypothetically, if they're priced at a certain price, is based on the market. Now, the market fluctuates back and forth every single day. But with the market, prices go up and down. So the best thing about the stock market, or I should say buying stocks in that point there, is the possibility to outpace inflation based on compound interest. What exactly is compound interest? Compound interest is basically saying how long it's going to take your money to triple and double in the next couple of years. That's very important to know. So one of the disadvantages of being in stock is naturally the rise and fall as far as the market. Now, the stock market is traded every day singly, and basically it's based on sales and buying, where it's based on the economy. So that market goes up, down every single day on that point there. But at the same time, one of the biggest disadvantages of that is you can lose your entire investment. So, example of companies are in the stock market, it could be Amazon, Microsoft, it could be KeyBank, and also local companies such as First Indian at that point there. So the question arises, you have eggs in either cash, you have eggs either in bonds, or you have eggs either in stock. What's the best way that we can get to the point where we can actually grow our money in the future? So the buzzword is diversification. So instead of having all your eggs in cash or having all your eggs in bonds or stock, let's take those eggs and spread them out over a period of time, meaning we put them in what we call a mutual fund. With a mutual fund is a professionally managed pool of money where over a period of time it can grow your money. So going back to that example, instead of having stocks and bonds in that point there, you have multiple eggs in stocks, multiple eggs in bonds, multiple eggs in cash, meaning if the stock market crashes or if it should go south and everything, you crack a couple of those eggs. You still have multiple eggs working for you. So what that is doing basically is when the stock market does fantastic, you have tremendous growth. When the stock market has losses, you have minimized growth because you don't have all your eggs in one basket. So any questions on that from there?
So it's actually, this is a good place to stop now. Brandy, are we taking a break?
Yes, we will be. We have a few more minutes to hear from Kurt first, and then yes, we'll take a 10-minute break.
Okay, well, let me talk a little bit about the 401k then. We'll be able to do that, all right?
Yeah, let's talk about the 401k and let's go right to Kurt, then we'll get to take a break.
Okay, fantastic. Another place to put your money for diversification with mutual funds is a 401k. 401k is an employee-sponsored plan. It's a defined contribution where the employer can match up to 100% of what you put in, depending on the way the plan is set up. The biggest advantage for the 401k is it's free money. I encourage everyone to invest in their 401k because that's free money that can help you achieve your goals and your financial goals in the future. That point there. So the key points to bring up in all of this is, first of all, making sure that you invest your money right. Secondly, it should be a long-term investment, which is very important at that point there. And then naturally, making sure that you sit down with one of my esteemed colleagues on the financial professional side to make sure that we're looking at your best interest and make sure we're doing the correct thing for you.
Rob, thank you. Thank you so much.
You're quite welcome.
Kurt, please talk about protection.
So as Forrest Gump says, it happens. So take time to make sure your wealth is protected and coordinated with your overall financial plan. You can break that down into 4 categories. The first category is life insurance. Life insurance is surprisingly affordable, especially for the young and healthy out there. So how much you need really just depends on your particular situation. You can take a look at your financial picture, both current and into the future. So for example, if you have a family and you're a parent and you have people that rely on you, you might have a larger need for a bigger life insurance policy. The second category of protecting your wealth is disability insurance. So your biggest, most important asset is the ability to earn an income. And what happens if you can't go to work because you become sick or you get injured? You can't work. So the company that you work for is likely not going to pay you a paycheck. Disability income pays you that paycheck should you not be able to work due to sickness or injury. The third component of protecting your wealth is health insurance. Health insurance really makes a difference in whether, when, and where you get medical care. So being uninsured can have severe financial consequences. The last category of protecting your wealth is property and casualty, or home and auto insurance. You could be the best driver in the world, but if somebody hits you and they don't have proper automobile coverage, your policy is going to kick in. So if you have a personal umbrella policy, for example, that can pay for medical bills and loss of income. It can protect you against lawsuits. It's very inexpensive to have. If you guys rent an apartment, you can have a renter's policy. Renter's policies protects your personal property, but it also provides you liability coverage as well. So to keep this short, you can protect your wealth in these 4 categories, and protecting your assets is really the fundamental component of any financial plan. So with that, I'll take it back to Brandy, and I guess we can take a break.
Brandy?
Thanks. So 10-minute break. So it's just about 2:20. I know we have several questions in the chat. So if you guys want to take a break, and then we'll reconvene at about 2:30, then we can go ahead and start addressing the questions that you may have.
Is the panel offline right now from the audience?
how you're joining us today, whether you are with us on Facebook Live. We have a few folks that are joined us in the Zoom Live. Some of you may be watching via YouTube. We want to take this moment to encourage you to send your questions in. Now, I know there's questions out there. I'm headed toward retirement, so I've got tons, and this show alone is certainly not long enough for me. So I want to encourage you to think of what questions you might have. You can post them in the chat. You can even email them to us at info@loveakron.org. These folks that are with us today, FSP, we are so excited about the information, the wealth of knowledge that they're sharing with us. We want to encourage you to continue to like, follow, and share Love Akron on your social media platforms. Understand this, that there are some second Wednesdays of the month that we're going to be asking them to come back and do a 10-minute spotlight to talk to us and give us some financial nuggets as we go throughout the remainder of life and life situations. So be sure to like, share, and continue to follow us. We're going to take a break, as Brandy said, but we'll be right back. Stay right there. See you in a minute.
As losses you have minimized because you don't have all your eggs in one basket. So, any questions in there from there? So, actually, this is a good place. Any questions in there from there? So,
And I know that we've had some questions and some of you have heard them kind of discussing some of those questions that we have. So we're going to just turn it back over to Brandy and we're going to go, or Alvin, and we're going to go from here to answer some of your questions today.
Brandy's on a roll, so Brandy, keep going.
Let me see what other ones are in here. A question of what is the minimum amount someone could deposit to open an investment fund, and what would be the minimum needed to at least keep it open? So I guess that question would be for you, Rob. Yep.
I can sort of answer that question. Recently, I talked about a little bit at that point there. Well, what does it take to start an investment at that point there? It's basically the cost of going to the movies, entertainment, anything else in that point there. It's a minimum amount. So based on the investment, and not going into detail on that point there, it can be anywhere between starting for $250 to $500 and just starting with a minimum of $50 a payment. So
that sounds very achievable. So even if you are making $35,000, maybe $50,000 a year, it's something that's doable. I remember when I first got out of college, I remember what it was like to only save $20 a month. It was very humbling, but you got to start somewhere.
And then the point I like to lay on that one there, Brandy, is also it's just a matter of budgeting. Understand your budget, understanding what your core monthly bills are, and also understanding your discretionary money where you can put towards something. I mean, a prime example, when I sit down and talk to clients where they say, well, I'm spending this X amount of money a month, and I go with their budget and I find out that maybe on their discretionary funds, they might be spending $100 a week on that. So if you break that down, $100 a week is $400 a month. That's $4,800 a year. That's roughly about almost $5,000 a year. So now we're not telling anybody to curb their entertainment and everything else there, but if you just take a little bit of that and put it toward an investment, you cut that in half, that gives you over $2,000 to put to a saving and investment plan. That's a start.
And then you're going to throw on a little interest, let your money work for you. That's a great opportunity there.
Yeah, just to pile on with a simple comment, it really isn't so much about how much you save, it's the behavior, it's the frequency of saving. And once you develop a pattern, it becomes you and it becomes natural. So pay yourself as you're paying everybody else. So it's not so much about the dollar amount, it's the frequency of the action.
Great point, Joe. Really great point.
And one other thing that I'll add on to that is it's very easy to set up an account and add over time. So you can set up automatic transfers that could happen the day that you're paid, where you're sending money directly to Schwab or Fidelity or wherever you're holding those investment accounts to be invested. So a little bit goes a long way. And just as Joe said, it's the behavior. And if that money's coming out every month, you're used to your budget to not necessarily have it for your expenses. And it gets easier over time to then know that that money is earmarked for savings and investing.
Wonderful. Thank you so much. Question for you, Joe. How would someone start to establish credit if they've never had it before? If they've never established credit, what are some simple ways that they can start building credit?
That is a very difficult thing to do. Stay tuned to what comes in your mail. There's a lot of junk mail, but at the same time, there may be some pre-approval offers. These are opportunities that may have very small credit lines. They may not be 5,000 or 10,000 credit lines, but maybe they're 1,000. It's still a credit. It's a trade line. And if you have a pre-approval for those and they don't come with annual fees and they're reasonable on how you use them, jump on those opportunities to get started. Other providers around the country will offer cash secured credit cards. Somewhat doesn't make sense, does it? Well, if I got the cash, why would I need to borrow? But if the goal is to start to establish credit, having a small line that's backed by cash, it produces no risk to the provider and allows you to build your credit. And then finally, another option is, if there is a parent, a guardian, where you can join them jointly on a credit. Not only does it report on that parent or guardian's credit report, but it also goes to yours in another way of establishing credit.
That's something that I personally did when I got out of college and tried to establish credit. I would put just my gas money on my credit card and, paid that off every month. And that's how I established my credit. I knew that was something that I could pay off every month and not have a crazy balance. Jesse has another question. Cryptocurrency is very volatile, but can be a great investment. How are the gains taxed when you sell?
So I can take that, or Rob can, whatever works. But I can take it. So cryptocurrency is incredibly volatile. So you certainly can invest in it, but I don't necessarily recommend it as a long-term play and having that full diversified portfolio. And that's one of those things, as Rob was mentioning, that you don't want to have all of your eggs in one basket. So while yes, it could skyrocket, it could just as easily go the other way. So it's important to have money in different areas working for you. When it comes to the taxation of it, so there's two different ways that you can pay taxes. You can pay ordinary income tax, and that's how your paychecks are taxed. But then there's also something called capital gains tax, and that is at a different rate than ordinary income. It's typically between 15 to 20%, which is oftentimes lower than ordinary income taxes. So you get a little bit of a break there.
Thank you, Sarah. Kurt, this question is something that you would probably want to answer. I have life insurance and disability insurance at my job. Do I still need to own my own policies?
It's a good idea to own your own policies, primarily because a lot of the group policies at work are not portable. So if you leave jobs or retire or get fired, you might not have that group policy anymore. Also, too, usually group insurance is guaranteed underwriting. So you don't have to qualify for it. So how they price for that is they have healthy people on the left, unhealthy people on the right, and they combine that together to come up with a price per thousand. So if you're individually healthy, the cost per thousand of coverage is going to be much less expensive on an individual contract.
Okay.
Hey, Kurt, may I add on that right quick, Kurt? The importance of having a life insurance policy outside the job on that point there. The most important thing, and Kurt knows this, and the whole panel knows this on this point here, is getting insurance while you're young and healthy. I can't overemphasize that. So I can use myself as a prime example. 3 years ago, I was in great health. I do have a large insurance policy myself, but in the past 3 years, my health has changed. For now, I don't qualify for life insurance. So we don't know when our health is going to change. So it's very important that you have life insurance, not only in the job, but off the job too.
Thank you, guys. Thank you for adding that additional point. Something that I wanted to share, even with our audience, working with a financial professional, sometimes the big question that you want to get answered first is, who do I go to for what? Everybody knows property and casualty, you go for that person for homeowners insurance or car insurance. But there's different types of financial professionals. We have a CFP, a certified financial planner, which is Sarah. We have an investment advisor, Rob. We also have an insurance specialist, Kurt. Sometimes it's hard to discern what each of those folks do and what's the difference. Do I work with all three, or do I just work with one? And so if the panelists could maybe speak to that, what's the difference between the two, and what's the value or the benefit of maybe having those professionals work together on a financial goal or plan that you are trying to work towards?
Sure. I'm happy to take that first if you'd like.
Sure.
So I am a certified financial planner. I would say it's oftentimes important to start with a planner and to start with a plan. From there, I would say I act as, a quarterback as to all the different areas that individuals need. So when we look at a plan, it's not complete if you don't have insurance. It's not complete if you don't have an estate plan, which is where you want your assets to go, God forbid something were to happen to you. It's not complete if you don't have an investment strategy moving forward that's comprehensive, that will help you to achieve your goals. So starting with that financial plan and allowing your CFP to be the quarterback to say, you know, you need insurance, you need to go refinance your loans, you need to go see this attorney for an estate planner, and allow them to help you make sure that everything is complete comprehensively, I think is very important.
Thank you very much, Sarah. Another question that individuals struggle with, especially if maybe parents or grandparents never worked with a financial professional, is there's the rumor that goes around that working with a financial professional is extremely expensive and only the wealthy have access or can afford to work with those individuals. So could any of the panelists kind of speak to some of those concerns, because maybe that's the reason why some in the audience have never even tried?
Yeah, I can comment on some of those concerns in that point there. One of the great things I have is I have a team of experts with me to make sure that we're taking care of you. I mean, the number one thing is we have a fiduciary duty to look in the best interest of our clients. And that means sitting down with them, talk to them about what's important to them in that point there. And then putting together a plan based on what's important to them, not important to Rob Johnson, not important to my company, and then carrying forward with the solution. So no, it depends on where you work as far as working with an advisor. But like I said, because I have a strong team that I work with at New York Life, we can put together plans for you and make sure that we achieve your best goals.
One thing I'll add to that is that we're in a world of YouTube. So there are so many free resources out there that you can go to if you were to have a question as well. But there's also a lot of information online and low cost options. So I know Schwab and Fidelity have planning that you can use for free on their website. And I know there's a lot of low cost investment options as well. So there's many different low cost options to get that planning help that you need as well and work with individuals.
Wonderful. We have time for one more question, and then I know we probably need to wrap up. I know Kemp will probably have some closing remarks. So the final question that we want to address is, what are some practical steps someone could take or make to start paying down debt? Should an individual be focused on paying off the smaller balances or the larger balances first, or does it matter?
I'll take that question. No two situations are ever the same. So the strategy should have the component of the following. What you pay off first, is it based on reducing overall interest expense, the cost of the debt, or is the motivation more budget related? And wanting to make sure that you're making your payments on time every time. If the strategy is budget related and you have a number of monthly obligations that if you consolidated a few that were smaller payments and it provided you additional cash flow, maybe that's the best strategy. If that isn't the issue, then the first question should always be, what do I do to reduce my overall cost? And it may not be paying off small balances with small payments because they have the lowest interest rates. Maybe you should be attacking the larger debt that has the highest cost and putting all your extra resources towards that. So it's based on your individual strategy and what you're trying to accomplish.
Those are really great points, Joe. I just want to say thank you again for joining us today. We hope that each of you have learned something new, but most importantly, we hope we provoked you enough to start being intentional about your financial well-being and future, and start connecting with a financial professional today. If you have questions about your personal situation, please reach out to Love Akron. They can connect you to us. If you or someone you know is in the financial services industry and is interested in learning more about the Society of Financial Services Professionals, again, please reach out to Love Akron, and we would love to sit down and talk with you. But again, thank you for your time, and have a great day. Lori? Is she talking on mute? Oh, she walked away for a moment.
Does Kemp have comments?
Oh, there she is. There you are, Lori. We're turning it over to you. I think you're on mute.
Well, let me tell you all, I was listening to that was amazing, just our time together today. I don't know if folks have questions, but you can send your questions to info@loveakron.org, and we will do our best to get those questions over to Brandy and to her team and the FSP group so that they can help us all become financially stable and smarter. So I want to say thank you to each of you, Alvin, Sarah, Robert, Joe, Kurt, and especially you, Brandy, for bringing this partnership to Love Akron. It's because of partnership that we can do the things that we're doing today and that we do every day here at Love Akron. So I just want to encourage you all to take the advice that you got and let's all become financially healthy. In the meantime, remember this, if you don't do anything else, oh, I should have told you guys, you got to come on mute because there's a thing we do at the close and you're just going to shout with me, Love Akron. That's it. You just spelt it out. Now you got to unmute though first. Okay. So even though tell us where you hail from. Alvin, you are where today?
I'm in Bloomfield, Connecticut, outside of Hartford, Connecticut.
Amazing. Joe Frankopan, you are?
Beautiful, sunny downtown Cleveland, Ohio.
Robert?
I'm in Cleveland, Ohio with my neighbors with the lawnmowers on.
Sarah?
I am in Fairlawn.
Nice. And last but not least, Kurt?
I'm in Cleveland.
Cleveland. Downtown Cleveland. Brandy, are you in Cleveland or Akron? You kind of...
I am in Akron. Well, technically Fairlawn, really.
Okay. Well, listen, thank you all for bringing such knowledge to us. As I said earlier, these folks will join us again. Check us out on second Wednesdays. We are right here, Love Akron Live at 1:30 every first, second, and fourth Wednesday. But on the second Wednesdays, we are planning to do a spotlight to help us all become financially healthy. So again, thank you all for being with us. And I want to say, if you don't do anything else today, make sure that you love Akron. We'll see you the next time.
Thank you.
Thanks, everybody.